Friends, I welcome you to the next lecture on Ind AS 8. In this lecture we are going to deal with prior period errors. Okay, so in our earlier lectures we have discussed about changes in accounting policies, we have learned about how to deal with changes in accounting estimates, but in this lecture I am going to deal only with how to deal with prior period errors. And the standard we can say specifies para 41 and 49. So the standard has prescribed the accounting treatment for prior period errors in para 41 to 49. So what is the prior period error? So prior period errors is omissions or misstatements in the entity's financial statements in the past. So we can say in one or more prior periods there have been certain omissions or there have been certain misstatements in our financial statements. See, if there are any omissions, misstatements in the current year financial statements, they have to be rectified before the date of approval of the financial statement. So there is no other go. So if you find that there is some mistake in the current year financial statements, then you have to definitely rectify them before the date the financial statements are approved by the management. Okay. If you don't correct them, then we can say that the financial statements are not according to the Ind AS. Okay. So one of the most important characteristic features of financial statement is relevance, reliability. If your financial statement is subjected to errors, then we cannot say that they are reliable. Okay. So in this lecture we are not talking about how to deal with the errors which have been committed during the current year, how to deal with them. Okay. So we are talking about the errors which have been done in the past, omissions in the past, misstatements which have been done in the prior periods, prior financial statements, how to deal with them in the current accounting year. So if you have come to know that some errors have happened in the past, in the current financial statement, in the current accounting period, how do you deal with them is what we are going to discuss. Okay. So these errors arise from failure to use or misuse of reliable information that was available when the financial statements were prepared or with reasonable effort could have been obtained and considered for preparation of financial statement in the past. So we are talking about information which was available but which was not used, or information which could have been easily obtained with reasonable effort and should have been used in preparation of financial statement, it has not been used. So in such cases the errors which arise is what is covered by this standard. Okay. Apart from this, it also covers the impact of mathematical mistakes, we can say mistakes in applying accounting policies, oversight, overlooking some information, misinterpretation of facts and fraud. So all these are covered within the meaning of the term prior period error. So if some mathematical mistakes have happened in the past, there is an error in accounting policy, there has been oversight, or there has been some misinterpretation of facts in the past, or there have been some frauds there in the past, the impact of all these things is covered by the definition of the term prior period errors. Is it clear? So how to deal with errors which have occurred in the past, omissions, misstatements which have occurred in the past in the current financial statement is what we are going to discuss in this standard. Now, how to deal with it? Accounting treatment subject to para 43. See, para 43 talks about impracticability. Okay. So we are not going to talk about what is impracticability right now. Let us first try to understand what is the accounting treatment for prior period errors. According to Ind AS 8, if you have come to know that some errors have happened in the past, that means in the prior period financial statements, in such cases, in the first financial statement which is prepared after the discovery of those errors, in that financial statement you have to do retrospective restatement. You have to do retrospective correction of those errors. That means if in the current year we come to know that some errors have happened in the past, then in the current year's financial statement, so when you are approving the current year financial statements, we have to give retrospective restatement. We have to do retrospective correction of the errors which have happened in the past. Okay. So how can we do that correction? Let us discuss in this particular we can say standard. So we are going to restate the comparative amounts for the prior periods presented in which the error has occurred. Let us say we are preparing current year financial statement, we have found that last year errors have happened. So when I prepare financial statement for the current year, I am going to show current year data and I have to show comparative last year data. So if I know the impact, if I am able to estimate the impact of this error in the last year's financial statements, I am going to correct it in the comparative information. Now if I correct the comparative information, automatically corrected opening balances would be taken for the current year financial statements and error has been rectified retrospectively, we can say. Okay. If the error has occurred before the earliest period presented, that means let us say I am preparing the present financial statements and I provide 1 year comparative, that is last year comparative. But if the error has happened before that, So I'm providing only current year and last year data, that's it. I'm not providing any other data. So in such cases I would have to estimate, and if the error has happened before the last year, before the period of comparative information, so in such cases I have to estimate what is the cumulative impact of that error, adjust the opening balances for the prior period comparative information. So I would have to adjust the opening balances for last year, not the current year, and then based on corrected opening balance sheets of the last year, I would have to prepare comparative information and then present my financial statements. So I have to do retrospective restatement. If the error would not have happened, what would have been my financial position? That position has to be disclosed in my financial statements. Okay. Now, impact on current year P&L account. See, the correction of prior period error is excluded from profit or loss for the period in which error is discovered. This is a very, very important point, because in our current accounting policies, that is based on Companies Accounting Standard Rules 2006, if you go through our current GAAP, if there are any prior period errors, those errors are adjusted in current year financial statements, current year P&L account. That means the impact is absorbed by the current year P&L account. Whereas Ind AS does not permit that. You cannot show the impact in current year P&L account. You have to show only retrospective effect. Okay, you have to adjust the financial statement of the period in which that error has happened, or if the error has happened before the comparative period which you have shown in your financial statement, then you have to adjust the opening balance of the comparative period. If you are not able to estimate the cumulative effect, then you can ignore it straight away. Is it clear? Now, it is adjusted in retained earnings. That means you cannot show the impact on current year P&L account, you have to adjust it in retained earnings. Any information presented about prior periods, including any historical summaries of financial data, is restated as far as back practicable. See, we all know that in financial statements we are also going to give some historical summaries of our profits, assets, liabilities, etc. So if it is possible to restate those historical summaries as far as back possible, you have to correct those information which is given in the financial statements. So as far as back possible, it is possible to correct those errors, correct it and give correct figures in the historical summaries. Okay. Now, impracticability of retrospective restatement. See, what is retrospective restatement? I'll try to discuss the points once again. If the error has happened in the last year, then definitely you can adjust the comparative information. The error has to be rectified in the comparative information which is provided in the current year's financial statements. That means you would correct the opening balance for the current year, and then based on that you have to prepare the current financial statements. If the error has happened before the last year and you are not providing such information in your financial statements, that means you are only providing current year financial statement and comparative 1 year. But if error has happened before that, if you are able to estimate the cumulative impact of that error up to the beginning of last year, then you have to adjust the opening balance of the last year, and then you have to prepare comparative information for last year and current year financial statement. That means you are doing retrospective restatement. If it is not possible to find out the period specific impact of the error, or you are not able to estimate the cumulative impact of this error, then in such cases you cannot do anything. You would have to start, we can say, giving the effect prospectively. Or what we have to do is we have to find out which is the earliest period from which it is possible to give retrospective restatement. From that date you have to start giving retrospective restatement. Sometimes the earliest period is current year. So current year's opening balance would have to be adjusted, and then you have to start applying, you have to just start preparing current year financial statements. Sometimes it may not be possible to do retrospective restatement from the past because sufficient information is not available, data is not available, it is impracticable, you are not able to estimate the period specific impact or at least cumulative impact. In such cases, you have to try to restate the financial statement from the earliest period possible, okay, for which retrospective restatement is possible. If it is not possible, sometimes the earliest period will be the current year itself. That means you will adjust the opening balance of the current year and then start preparing the current year financial statements. Even for doing that, you need to have the cumulative impact of the error at least till the beginning of the current year. If that is also not possible, then you have to just ignore the impact of that error and you have to just note it, you have to disclose that fact in your notes to accounts. Okay. Now, when it is impracticable to determine the period specific effects of an error on comparative information for one or more periods presented, the entity shall restate the opening balances of the assets and liabilities and equity for the earliest period for which retrospective restatement is practicable, which sometimes may be the current period. Okay. Now I have just prepared a blank financial statement, just try to understand here. So let us say we are showing 4 years information. 4th year is the current year, 3rd year is comparative, year 2 and year 1 are the prior periods, let us say earlier periods, okay, they are not covered by our financial statements. So now, if errors have happened in the year 1, year 2 and year 3, so what should we do? We have to find out if you are presenting all the 4 financial statements, you are presenting all the 4 periods in the financial statement, then you have to retrospectively restate each financial statement, okay. If you are not showing all the 4 years, you are showing only year 4 and year 3. In such cases, find out what is the cumulative impact of the errors which have happened in year 2, year 1, adjust it in the opening balances of year 3. In such cases, as per Ind AS 1, you would have to prepare an opening balance sheet at the beginning of 3rd year, and that opening balance sheet would consider the cumulative impact of errors which have happened in the 1st year and 2nd year. That means you would have to prepare opening balance sheet for 3rd year, and that balance sheet would cover the impact of cumulative impact of year 1 and year 2 errors, okay. That means the cumulative impact of year 1 and year 2 errors would be adjusted in the opening balance of year 3. Year 3 corrected information would be presented, and year 4 current information will be, we can say, presented, okay. Let us suppose an error has happened in all the 4 years. In such cases, we are not able to estimate what is the, we can say, the impact of the error on year 1. We are not able to estimate. So what can you do? Just ignore it. If you are able to estimate what is the impact of the error on year 2 financial statement, then definitely yes, that error has to be rectified in the opening balance of year 3, and then we'll use the current information for year 4 balance sheet. Let us suppose the error of the impact of the error on year 1, year 2, year 3, we are not able to find out the period specific impact, but at least we are able to estimate the cumulative impact of all the errors which have happened in year 1, year 2, year 3, we are able to estimate the cumulative impact. Then year 4 opening balance would be changed, and then we will start preparing the financial statement for year 4. So that is how you have to deal with the, we can say, accounting for prior period errors. If all 4 years information is presented, you find that there is an error in any one of the year, then in such case you have to restate that particular information, automatically opening balance for the next period would be corrected, okay. Now disclosures, what are disclosures required? The nature of the prior period error you have to describe. You have to give sufficient information for the user to understand what that error was first of all. Next, for each prior period presented, to the extent practicable, the amount of correction which you have done in each line item of the P&L account, and then what is the correction required in the EPS which is disclosed based on Ind AS 33. So you have to, in your notes to accounts, you have to mention by how much amount each line item in the P&L account of the current year in the previous year has been affected because of this error. Apart from that, last year's EPS, what is the correction required, by how much the EPS would have changed in the last year if you would have known this error in the last year itself, okay. So by how much you have to do adjustment to the EPS which has been reported in the last year, that also has to be disclosed in notes to account. So it's the impact of the error on EPS, the impact of the error on each line item of the P&L account has to be disclosed in notes to account. You have to describe the error as well. Next, the amount of correction at the beginning of the earliest prior period presented. See if the error has happened before last year. In such cases, we just take the cumulative impact and we adjust it in the opening balance of the last year. So by how much the opening balance of the last year have been adjusted, that also has to be disclosed. If retrospective restatement is impracticable for a particular prior period, the circumstances that led to the existence of that condition, description of how and from when the error has been corrected. So we have just now discussed that there can be situations where it is impracticable to find out the period specific effect. You are not able to estimate the cumulative effect as well. So in such cases, you have to describe the circumstances in which you are not able to estimate the period specific, we can say, impact of the error, and from which date you have been able to retrospectively restate the financial statements to correct the prior period errors. You have to disclose it in notes to accounts. So this is how you deal with